Viewers at home, you are welcome to my presentation on IAS 12, Income Taxes. IAS 12, Income Taxes. If this is your first time of coming across my channel, or if you have not subscribed in the past, please hit the red subscribe button and turn on the notification bell icon so that you'll be able to receive a notification message each time I drop a new video. If you are a returning subscriber, I say thank you and God bless you. IAS 12, Income Taxes. IAS means International Accounting Standard, number 12. This standard, there are two elements of taxes. Two elements of taxes that are dealt with in IAS 12. Two elements of taxes that are dealt with in IAS 12. Number one, we have current tax. Current tax. Number two is deferred tax. Number one, current tax. Number two, deferred tax. Current tax. Current tax is the amount of income taxes. Amount of income taxes payable or recoverable in respect of taxable profit or tax loss for a period. Amount of income tax or taxes payable in respect of taxable profit for a period is said to be the current tax. I repeat, current tax is the amount of income taxes payable in respect of the taxable profits for a period. That is current tax. To calculate your current tax, you multiply your tax rate. Tax rate multiplied by the taxable profit. Tax rate times taxable profit. That will give us the current tax. Just if the taxable profit, is $50,000 and the tax rate is 30%. If the taxable profit is $50,000 and the tax rate is 30%, therefore current tax, that will be 30% of $50,000. 30% of $50,000, that will be the amount of the current tax payable for the period. Therefore, the current tax payable for the period will be $15,000. That is current tax. So that is your current tax. We have tax rate multiplied by the taxable profit. Then, what do we mean by taxable profit? Taxable profit. I want you to note that tax rate is the rate at which taxes will be payable for the period. The tax rate agreed by the tax authority at which taxes will be payable for the period. That is the tax rate. So, then what do we mean by taxable profit? Taxable profit. Taxable profit is the profit for a period. Profit for a period determined in accordance with the rules established by the taxation authorities. Taxable profit is the profit for a period determined in accordance with the rules established by the taxation authorities. When you the amount of profit you determine by following the tax rules in a given jurisdiction or in a given tax jurisdiction is said to be the taxable profit. That is why I said it's the profit for a period determined in accordance with the rules established by the taxation authority. To arrive at the taxable profit, series of adjustments will have to be made to the accounting profit. You have to make several adjustments. There are number of adjustments, series of adjustments that will need to be made to the accounting profit before you can arrive at the taxable profit. That means the taxable profit is the adjusted accounting profit. Adjusted accounting profit in accordance with the tax rule. That means taxable profit is the adjusted accounting profit in accordance with the tax rules. That means you will need to adjust your accounting profit by following the rules established by the tax authority. That is the taxable profit. Then what do we mean by the accounting profit? Accounting profit. Accounting profit. Accounting profit is the net profit or loss for a period before deducting tax expense. The net profit or loss for a period before deducting the tax expense. That is, your accounting profit is the profit before tax. Profit before tax in the statement of profit or loss. Profit before tax in the statement of profit or loss. That is said to be the accounting profit. So how do you determine the taxable profit? Computation or tax computation format, or the format for the computation of the taxable profit. Computation of taxable profit. I've told you that your taxable profit is the adjusted accounting profit. The adjusted accounting profit. So that means I've told you that the accounting profit is the profit before tax. So that means you are going to start with the net profit before tax. The one in your account, the one in your financial statement. Then you now add non-allowable expenses. You add non-allowable expenses. By non-allowable expenses, we mean those expenses which the tax authority does not allow for deduction in the computation of the taxable profit. Those expenses which the tax authority does not allow in the computation of taxable profit are said to be the non-allowable expenses. Before an expenses must be allowed for tax deduction, it must obey this principle. The first W stands for wholly. That means the expenses must be incurred wholly for the purpose of generating revenue. The R stands for reasonably. The E stands for exclusively. and the N stands for necessarily. For an expenses to be allowed for tax deduction, those expenses must have been incurred wholly, reasonably, exclusively, and necessarily for the purpose of generating revenue. Any expenses that are not wholly, reasonably, exclusively, and necessarily incurred for the purpose of generating revenue are not allowable for tax purpose. An example of non-allowable expenses is the accounting depreciation. Depreciation is not allowed. It's not allowable. Because we have different methods of computing depreciation. But in lieu of depreciation, capital allowance is granted. So, meaning that capital allowance will be allowed, will be granted in place of depreciation. Depreciation is not allowable, but capital allowance is granted in lieu of the financial accounting depreciation. Fines. When you violate the law, so you pay fines. You are not expected to violate any law. So the fines you pay is not allowable for tax purpose. Any capital expenditure are not allowable for tax purpose. Expenditure of capital nature are not allowable for tax purpose. Those expenditures that we add to the value of the non-current assets are not allowable for tax purpose. We have a lot of allowable expenses, but I'm not in tax class now, so I will limit you to this. So I said you add non-allowable expenses. Then we now deduct. And if you may also add taxable income. Add taxable income not reported in the financial statement. The taxable income not reported, those income that are taxable but which are not recorded in the financial statement. Those income, though they are taxable, but they have not been recognized. They have not been recognized in the financial statement, so you add them. Then you less allowable expenses not reported. Less allowable expenses not reported in the financial statement. Those allowable expenses that have not been recognized, those ones that were not recognized in the financial statement, though the tax allowed them, we are going to deduct that. Then no taxable profit reported in account. You less no taxable profit reported in account. Reported in account. These profits are not taxable, but they have been reported. That means they have been included in the statement of profit or loss. That means those profits form part of the profit before tax, but they are not taxable. E.g., profit from disposal of an asset, profit from disposal of non-current assets. So those profits that are not taxable, or profit of a company that have been granted a pioneer. So a pioneer company which falls within the tax holiday period, those profits that are not taxable, so you less it. After this deduction, you get the adjusted profit or accessible profit. Accessible profit or the adjusted profit. From this profit, you less capital allowance. You less capital allowance from your accessible profit. After deducting your capital allowance from the accessible profit, you arrive at the taxable profit. I've told you to get your current tax, you apply your tax rate on the taxable profit to get your current tax. So meaning that you are going to apply tax rate on this taxable profit to get our current tax. So you apply your tax rate on the taxable profit. So tax expense. The determination of the amount of tax that will be charged as an expense in the statement of profit or loss. Tax expense. The amount of tax that will be deducted in the statement of profit or loss to arrive at the profit for the period. This is the aggregate amount. The aggregate amount, tax expense, is the aggregate amount included in the determination of net profit or loss for the period in respect of current tax and deferred tax. The aggregate amount included in the determination of net profit or loss for the period in respect of current tax and deferred tax. To get the amount of tax expense in the statement of profit or loss, you make use of this format. You have provision for income tax for the period. Provision for income tax for the period. So this same provision will be recognized as liability, current liability in the statement of financial position. Then to this, we want to get the amount of tax expense. You start with provision for income tax for the period. Then you add under provision for previous year income tax. Add under provision. You add under provision for previous year or prior year income tax. The under provision for prior year. I will still explain what under provision means. Then you also less over provision. Less over provision for prior year, that is previous year. Prior year income tax. You less over provision. Then you now add increase in deferred tax. Increase in deferred tax should be added. Then you less decrease in deferred tax. After this adjustment, then you get the amount of tax that will be expensed in the statement of profit or loss. Provision for income tax for the year, for the period or for the year, you add under provision for prior year income tax. Then you less over provision for prior year income tax. Then you add increase in deferred tax. You add increase in deferred tax and less decrease in deferred tax. Then you arrive at the amount of tax that will be expensed in the statement of profit or loss. I want to note that provision is based on estimate. Provision is based on estimate. Now, if you want to compute the amount of tax that will be expensed in 20x8, this is the accounting year. Accounting year is 20x8. The previous year, the year preceding 20x8 is 20x7. You know, for 20x8, you make provision for tax for that year. And it is possible the provision that will be made in the account may not be the same as the amount that the tax authority will agree on. The provision you make in account may not be the same as the amount the tax authority will agree on as your tax to be paid or tax payable. Where the provision you have made for the period, I've told you that provision is based on estimates. Where the provision you have made for the period is greater than the actual tax the tax authority agreed on or agreed upon, then you know your provision you have made exceed the amount the tax authority agreed upon, then the provision is over. That is over provision, which should be deducted. But where the provision you have made in the account is less than the actual amount the tax authority agreed upon, then that is to show that the provision you have made, it is less than the actual amount the tax authority agreed upon. That means the provision you have made is under. That is under provision. Please take note of that. I want to note in your trial balance, under provision for prior year tax will be at the debit side of the trial balance. If you are given the final account, that is, you want to prepare statement of profit or loss, the under provision will be at the debit side of the trial balance, while over provision should be at the credit side of the trial balance. Take note of that. The provision for income tax for the year should be in the note, or you may be given or you may be required to compute that by applying the tax rate on the taxable profit. So please take note of that. Now, that is how to determine the amount of tax that will be expensed for the period. Then for the deferred tax liability will always be at the credit side of the trial balance. Deferred tax liability will always be at the credit side of the trial balance. Then where you are not given another deferred tax in the additional information, maybe the one in the trial balance, maybe it is 500,000. Then in your additional information, you now have 700,000. That means deferred tax has increased by 200,000. The increase in deferred tax should be added. Why? If the one in the trial balance, if it is 500,000, and it's now in the one additional information is now 400,000, that means there is a decrease of 100,000, which should be deducted in the computation of tax expense. So I've told you that under provision for prior year tax will be found in the debit side of the trial balance, while over provision for prior year tax should be credited to the trial balance. Please take note of that. I want to take a question as I want to solve two questions as work example. So this presentation will be taken as part 1. The part 2 will cover the deferred tax. Example 1. This question is obtained from the study test of the Institute of Chartered Accountants of Nigeria, ICAN, by Emily Wolf International. Enugu Traders Limited had an accounting profit of 789,000 naira for the year ended 31st December 2022. The accounting profit was after depreciation of 70,000 naira and included a profit on disposal, that is capital gain, of 97,000 naira. The company had incurred borrowing costs of 70,000 naira in the year, of which 10,000 naira had been capitalized in accordance with IAS 23. Enugu Trader Limited paid fines of 125,000 naira for violating the traffic law. At 1st January 2022, the tax written down value of machinery was 120,000 naira, and for building was 600,000 naira. We have tax regime. All borrowing costs are deductible for tax purpose. Capital gain are not taxable. Fines are not tax deductible. That is, fines are not allowable. Not tax deductible means they are not allowable. Capital gain are not taxable. Borrowing costs are not tax. All borrowing costs are deductible for tax purposes. That means all borrowing costs are allowable for tax purpose. That is the meaning. Accounting depreciation is not allowable for tax purposes. For tax purposes, accounting depreciation is not allowable. Capital allowance is claimable at 10% per annum for building and 15% per annum for machinery, applied to tax written down value at the start of the year. Tax paid is 30. Tax rate is 30%. Or tax paid is 30% required. Compute the tax payable. So you want to compute the tax payable. So now we may have Enugu Trader Limited computation of tax payable. Then you start with the accounting profit, that is the net profit as per account. The net profit as per account. How much is the net profit in the account? We have Enugu Traders Limited had an accounting profit of 789,000 for the year ended 31 December 2022. The accounting profit is 789,000. 789,000. Then you now add non-allowable expenses. I've told you earlier that non-allowable expenses are those expenses which the tax does not allow for deduction. Those expenses that the tax authority does not allow for deduction for tax purposes. That is what we mean by non-allowable expenses. Now let's go through the question. The accounting profit was after depreciation of 70,000. I've told you that depreciation is not allowable, but capital allowance have been granted in lieu of accounting depreciation, and included a profit on disposal, that is capital gain of 97,000. We said profit on disposal is not taxable. That is, even if this information are not there, they have told us we should know that the capital gain, because I've told you that those income or expenses that are allowable for tax purpose are those that are wholly, reasonably, exclusively, and necessarily generated or incurred for the purpose of the revenue or trade or business. Now, our borrowing cost. Okay, now if you look, they said capital gain are not taxable. So that means we will need to deduct the capital gain of 97,000 since it is not taxable and it has been included in the accounting profit. So depreciation is not allowable, so we need to add it back. The company had incurred borrowing cost of 70,000 in the year, of which 10,000 had been capitalized. This 10,000 have been, of the 70,000, 10,000 have been recorded as an asset. That means the only amount they have deducted in the statement of profit or loss as finance cost is 60,000, while 10,000 have been included in the value of the asset in accordance with IAS 23. Then if you look at the question, say all borrowing costs are deductible for tax purposes. If all borrowing costs are tax deductible, that means the 10,000 that have been capitalized, we will need to deduct it. We need to allow it. So we will need to deduct that. Then Enugu Trader paid fines of 125,000. We said the fines are not allowable for tax purpose. They have even told us fines are not tax deductible. That is, they are not allowable, not tax allowable. So that is the meaning. So that means we will need to add back the fines. We need to add the fines. So now, let's compute our tax. So we have depreciation. We said depreciation is not allowable, and depreciation amounted to 70,000. You are going to add it back since it is not allowable for tax purpose. Then we said fines. Fines which have been expensed. We said it's not allowable for tax purpose. And fines is 125,000. Fines is 125,000. Then those two items are not allowable for tax purpose. So when you add it, you have 195,000. So if you now add 195,000 to 789,000, 789 plus 125, then we have 914,000. So now less the following items. with less. Now, let's go through the question. They said it includes profit on disposal. Profit on disposal, which is capital gain of 97,000. And you have even told that it's not taxable. Capital gain are not taxable. Since it is not taxable, and that have been included in our accounting profit, so you will need to less that. So we deduct the profit on disposal. Profit on disposal of 97,000. So we need to deduct that. Then aside that, the borrowing cost of 10,000, since you were told that all borrowing costs are tax deductible, the 10,000 which have been capitalized, which have not been deducted, you will need to deduct it since it is allowable. I've told you that tax deductible means allowable. So, since it is allowable now and it has been capitalized, that means it have not been expensed in the statement of profit or loss. So you will need to deduct it now. So we have borrowing, capitalized borrowing cost, capitalized borrowing cost of 10,000. Capitalized borrowing cost of 10,000. Then, if you add this, then you have 107,000. 107,000. If you now less 107 from 914, so then you have the assessable profit to be 807,000. That is the assessable profit. Assessable profit. Remember, I've told you earlier that capital allowance is granted in lieu of depreciation. So you now less capital allowance. Capital allowance. You have been given the qualifying capital expenditure to include. You were told at 1st of January 2022, the tax written down value of machinery was 120,000 and for building was 600,000. So machinery 120, building 600,000. You were also told that capital allowance is claimable at 10% per annum for building and 15% per annum for machinery. So now let's determine our capital allowance claimable. So capital allowance. You are given building and the tax written down value of building is 600,000 and the capital allowance rate on building is 10%. So building 10% of the cost of 600,000, and that will give us 60,000. Then we also have machinery. Machinery, the capital allowance rate on machinery is 15%, and the tax written down value of machinery is 120,000. 15% of 120,000. 15% of 120,000. Then you have 18,000. If you add 18,000 and 60,000, then you have 78,000. That is the capital allowance claimable. So you now less capital allowance of 78,000. 78,000. If you deduct it from 807 minus 78, you have 729,000. 729,000. Let me recast. So This is totaled 984,000. If you subtract 107,000 from 984, then you have 877,000. 877,000 minus 78,000. Then you have 799,000. This 799,000 is our taxable profit. Taxable profit. Then you now apply your tax rate on the taxable profit. Then you get tax payable. Tax payable. The tax rate is 30%. 30% of 799,000. Then you have 239,700. 239,700. That is the tax payable. That is the solution to the first work example. Now example 2. In 20x8, Datin Co. had taxable profits of $120,000. In previous 20x7, income tax on 20x7 profit had been estimated as $30,000. The corporate income tax rate is 30% required. Calculate the tax payable and the charge for 20x8 if the tax due on 20x7 profit was subsequently agreed with the tax authority as $35,000 and B 25,000. You want to calculate the tax payable. If the amount of tax agree with the tax authority, if it is 35,000 and when it is 25,000. So this question is obtained from BPP ACCA study test. BPP ACCA study test. Financial reporting. In 20x8, Datin Co. had taxable profit. You are given taxable profits of 120,000. Remember, I've told you that to get the amount of provisions that will be made, that is your current tax. To get your current tax, that is provisions, you apply your tax rate. The taxable profit is 120,000. I've told you that to get your current tax, which is your current tax provision, you apply your tax rate, which is 30% on the taxable profit. So, then, now let's have the solution. So, Datin Co. You have to compute, you have to calculate the tax payable and the tax charge for if the tax due on 20x7 was subsequently agreed with the tax authority. So, tax payable now. Tax payable. I've told you that your tax payable, which is your current tax, that is the amount of tax payable. I've told you that you apply your tax rate, and the tax rate is given to be 30% of the taxable profit. 30% of taxable profit, and our taxable profit is 120,000. So 30% of 120,000, and that will give us 36,000. That is the amount of tax payable for the period. Then you also to compute the tax charge. Tax charge means the amount of tax that will be expense. Tax expense in the statement of profit or loss. The amount of tax that will be expensed in the statement of profit or loss. I've told you that to get that, you start with the provision for current year provision for current year income tax, which is 36,000 as obtained above. Then I said you add under provision for prior year. Now let's check prior year. You know, prior year is 20x7. Income tax in the previous 20x7, income tax on 20x7 profit had been estimated as 30,000. This is the provision for 20x7, but now agree as 35,000. That means the provision which was made for 20x7 is less than the actual amount agreed with the tax authority. That means the provision is under. So I said you should add under provision for prior year income tax. Add under provision for prior year. Income tax, which is 35,000 minus 30,000. Then you have 5,000. That is the amount of under provision. If you add 5,000 to 36,000, then you have 41,000. That is the tax expense for the period. In B aspect of the question, provision for income tax now. Tax expense, provision for current year income tax, it still remains 36,000. Remember, the provision for prior year was 30,000, but subsequently agreed with the tax authority as amount agreed with the tax authority is 25. The provision of 30,000 exceeds the 25,000 agreed with the tax authority. That's to show that there is over provision. So you less over provision for prior year income tax. Over provision, which is 30,000 minus 25,000. Over provision of 5,000. Then the amount of tax expense will be 31,000. So this is the part 1. Part 2 shall cover the deferred tax computation.